day and welcome to our short explanation of a robo-advisor called Wealthsimple. We're going to explain what Wealthsimple is, what an ETF is, and we're going to demonstrate how to set up an account. So let's get started. Wealthsimple, as we mentioned, is a robo-advisor. Their slogan is investing on autopilot, and all that boils down to putting your money into the stock market without big fees or complexity. Wealthsimple is a Canadian company. Well, it's Canadian-based. It now operates in New York and to cover all of the US, and London, England for the UK market. Its board of directors includes some pretty heavy hitters in the finance industry. So let's dig into what makes Wealthsimple different from the things that you've been doing in the past. Most people are familiar with mutual funds, in which a guy, that's really just a guy, and usually with a small team of researchers, takes informed guesses as to which stocks are going to go up and which ones are going to go down, and then trades those stocks accordingly. This is called active investing, and there are two big problems with it. The first is that the profits active investors make are always less, and that always is a slight exaggeration, we'll get to that in a moment, but always less than what the stock market does on average. If you just bought a small number of shares in each of the companies that make up the stock market and held those stocks, you would make more money than if you bought and sold the shares in those companies actively. The other problem is that mutual funds charge a huge amount. They cost you 2.25% of your investment. Now, the key to that sentence is the last part. Mutual fund companies don't take 2.25% of your profits. They take 2.25% of every dollar you invest every year, regardless of whether you made or lost money. So instead of investing in individual companies, Wealthsimple invests in something that's called ETFs. An ETF is just an acronym for Exchange Traded Fund, and they're quite simple to work with. They're an exact copy of a particular index from a market. Now, I realize that's a lot of jargon, so let's clear this up. For example, you've probably heard of the S&P 500 or the TSX 300. Well, the S&P 500, for example, is just the Standard & Poor's stock market top 500 companies. The TSX 300 is the Toronto Stock Exchange's top 300 companies. The people that run those stock exchanges decide which companies are included in their 500 or their 300 or their 100 or whatever index they've built. So why not just buy the shares in each of the companies listed on the S&P 500 or TSX 300? Or the FTSE 100, which by the way is London, England, or the Nikkei 225, which is the Japanese market. That is what an ETF is. It's buying a share of each company in an index. ETFs diversify your risk. For instance, when Hewlett-Packard and Bank of America got into trouble, I think it was around 2012, the Dow Jones Stock Exchange continued to allow them to trade on their platform, so you could buy and sell Bank of America and HP. But they were removed from the Dow Jones Index. That meant that all ETFs matching the Dow Jones immediately sold HP and Bank of America, and then bought the two companies that the Dow Jones replaced them with, which in this case was Nike and Visa. They did not have to do any costly research, they just did it. For that service, ETFs charge an average of 0.31%. So let's call it a third of 1%, which is way less expensive than the 2.25% that your mutual fund hustler will sell you. Do you think they can do better than what the average of the market does? Well, they can't. It's been shown in dozens of studies that buying individual stocks is a fool's game. Wealthsimple is more than ETFs. If Wealthsimple just bought a single ETF and then resold it to you, you shouldn't use them because you could just buy the ETF yourself. Wealthsimple invests in many ETFs to spread out that risk, and it does it through an automated process to make sure, so it's always rebalancing, to make sure that you're not invested in something that's tanking out really hard. They also buy government and corporate bonds that are known as debt. So when Audi or the US government or Microsoft or Costco want to borrow money, they put out what is known as debentures. These are just debt notices that big companies buy a portion of. For example, in May of 2020, Apple borrowed $8 billion, and companies like Wealthsimple bought tiny portions of that debt, which Apple is paying 0.75% interest on. I think you'd agree that it's highly unlikely that Apple would not be able to pay that money back. So for Wealthsimple, this is a very simple way for them to reduce the risk and therefore your risk. For example, this is what I am invested in with Wealthsimple. You can see it's 80% equity, which is the stock market and various ETFs, and 20% fixed income, which is debt, bonds. When you sign up for Wealthsimple, you're asked a series of questions to determine what your risk comfort level is. They keep costs down by having about 3 different bundles of ETFs and bonds. You can see here in their little slider that goes back and forth, you can see that if you have a high risk tolerance, well, you'll be put more into stocks and less into bonds. Look what happens as you slide down the scale. More bonds and less equity. Equity being stocks, income. From what I've seen, there are 3 bundles that they work on. They have a 50-50, 50% ETF, 50% bond bundle, which is great for people with very low risk tolerance, like retirees or people saving up to pay for something like a car. Then they have a middle tier for most people that are more ETFs and less bonds. And then they have the category I'm in, which is a long-term investor in the 80-20 split. I'm not worried about cashing out in the next 10 or even 15 years. I'm saving for retirement. So I'm okay if the stock market goes up and down like it just recently did. So that gets us to what the real cost of Wealthsimple fees are. So this will be a bit complex, but I'll get through it. And if you're not interested in this, just skip ahead a bit. So Wealthsimple charges most people 0.5%, so half of 1%, for all of this management diversification that you see here. You also need to add in the cost of the ETFs that you buy, because of course, Wealthsimple doesn't have those ETFs. They didn't create them. They're not managing them. They're just buying them. So because they're buying millions of dollars in ETFs, they've negotiated their ETF fees down to 0.2%. Yes, that's correct. That 0.2 is about 30% less than what you can buy ETFs as an individual. So if you add that up, 0.5% for their fee plus 0.2% for the ETFs that you're buying into, that makes the whole Wealthsimple experience cost you about 0.7%. Compare that to what most people have invested in for the last 50 years, which is mutual funds. They charge an average of 2.25%. So you can see that Wealthsimple is about 66% less expensive. As you can see in the middle here, if you invest more than $100,000 with Wealthsimple, their fee drops to 0.4%, making your total cost about 0.6%, and that's 75% less than mutual funds. Look, if all those numbers are just too confusing, think of it this way. A recent Canadian study showed that mutual funds cost the average person $323,000 over their lifetime. Wow, that is a lot of cash paid to your investment advisor or bank or whoever you're buying your mutual funds from. If you just bought ETFs using Wealthsimple or some other Roboadvisor for that matter, your cost would have been closer to $70,000 over your lifetime. I don't know about you, but $250,000 is an awful lot of money I want to keep in my pockets and not pay out to somebody running mutual funds, which is going to cost me an awful lot more and return less. And there's also a way to discount those fees. If you open an account with Wealthsimple, they will not charge you fees on the first $5,000 for the first year. So that means if you open an account and you put, say, $500 in the account, or $1,000 or $2,000, anything up to $5,000, and you can start with as little as I believe it is $100, they will charge you 0 fees for that. However, you can double that amount from $5,000 to $10,000 without fees for the first year if you use a reference code. And how do you get a reference account? Well, I'm glad you asked. There's mine. Now, you ask what's in this for me. I have nothing to do with Wealthsimple. I don't make any money from this video. I don't have any kickbacks coming through any back doors. I have no association with them in any way. My brother doesn't work there. There's nothing going on at all. I'm creating this video because an awful lot of people are asking me about Wealthsimple. And for some reason, Wealthsimple doesn't have this type of video out online. So I thought I would create it. Now, what benefit do I get from this? I also get $10,000 without additional fees from Wealthsimple if you use my link. So I would greatly appreciate it if you would use that JQWVWA reference. But if you don't want to, that's fine. Just go ahead and create an account. But if you do that, if you create an account without the link, your first $5,000 will have no fees on them for the first year. And like I said, you can double that to $10,000 if you use a link like mine. I have talked with some people who have specific types of investments that they feel they need to be involved in. So there are some people that want ethical funds and other people want halal. As you can see here, this is what you will get if you are interested in ethical, what are so-called ethical funds. Halal funds are those that are compliant with Islamic law. And you can see that the halal fund that they offer is 50 stocks selected from around the globe. They also support RRSPs, TFSAs, and just a standard personal account with regular taxation. If you don't know what those are, just quickly Google each one and it'll tell you. But it boils down to they're retirement things that have different types of taxation attached to them. So it depends on what you have currently. Well, a lot of robo-advisors don't have somebody you can talk to. What they are is fully automated computer systems. And while it may work for some, most people, especially people that are investing larger sums of money, really want to talk to somebody. You can call these guys pretty much anytime. In Canada, you can phone them at an 800 number and talk to them, a real person. Well, within a few minutes of calling, you never seem to have a long wait. It says here now between 9 a.m. and 6 p.m. Eastern. Most people that are interested in this type of investment are not looking to manage it. They just want to set it and forget it. So Wealthsimple offers auto deposit, so you can have have the system take $200 out of your bank account every week or every 2 weeks or whatever you want. It'll also do what's called a DRIP in the industry, which is a dividend reinvestment program. So when you get dividends in from the stocks that you own through your ETFs, what do you do with it? Well, in a lot of cases, they just sit there and get old. And that's not very good. You want your money making you money. So in Wealthsimple, the dividends get reinvested back into the stock. So you're buying more stock automatically. The system auto rebalances your account periodically as well. So as I mentioned earlier, if a particular ETF is tanking out or having a particular problem or there's some crisis, it will remove that ETF and replace it with another one. So let's get started and create an account. We'll show you how easy this is to set up. It takes about 5 minutes. So for fun, we'll go to my link, but you could just, if you don't want to, that's fine. You could just go to start investing and it'll create you an account. So, but I'll just go to my link and you can see it just takes you through. Okay, now I'm going to use fake information here because I already have an account. There we go, fake Ian. Sign up. And they do offer stock, you can buy individual stocks with them. You can also put a savings account in. That's not what we're interested in. What we're interested in here is investments through their primary product. So let's just click investing on autopilot and continue. And again, this will take about 5 minutes. So my first name is fake Ian. My last name is Matthews. 1970. How was that? Phone number 403-555-1212. I'm a citizen of Canada. Now this is available to Americans, Canadians, and Brits. Let's click past that. You don't have to answer this. The reason they're asking what your gender is because of life expectancy. So I'm going to say I'm a man, which I'm hoping. And let's set an address. And I just filled it in, nothing interesting there. It's fake. And my billing address is the same as my residential address because I'm going to assume you're sitting at home. I'm going to say that I'm retired, but you could put in whatever you want here. I'll put in a social insurance number. And the reason they need that is because they have to report your information through to the government for tax purposes at the end of the year. And as you can see here, there's a quick question about, your particulars, but for most people, this will all just be blank. So I'm going to leave that alone. How did you hear about us? I'm going to say I heard about it on a blog. And what blog? Let's go with partisanissues.com. How's that? Now that's just for reference. Nobody makes any money at that. That's just for their information. Confirm details, and create a portfolio. So let's get through that. Now, what am I investing for? I'm investing for retirement. Now, you could, say you're doing something else here, but that's what I'm looking for. And again, the reason what they want to know that is because they have to set your risk tolerance. If you're about to buy a car and you've got $30,000 set in the system, Well, you don't want to put that into something more risky. If you're retired, you don't want to put it into something more risky. You want to put it into something less risky. If you're like me and you're set for the next 20 years, where you're just saving, you're not saving for anything in particular, you're just saving for retirement, well, then you can afford to be in a little bit high risk category. But for the sake of argument here, I'm going to say that I want to retire. And I'm going to say that I'm going to retire at the age of 67. Just totally made that up. Household income before taxes, currently, because I'm going to claim that I'm retired, I'm going to say is $50,000 because my wife and I have some small income from our government pensions and things like that, we'll say. I don't, by the way, but let's just say I did. So 50,000 is actually quite a lot, but that's what we'll say. How much do we have in savings? Well, let's say that we have $250,000 in savings. So modest amount, but enough to get through. And total assets, well, we own the house and we own the cars. So our total assets are about, let's say, they're $600,000. And total debt, we have nothing that's outstanding. But let's say you did. So let's say you have a car loan or something else. So I'll put down that you have $21,000 in debt. Next. Now this is asking how experienced you are. So, and again, the more experienced you are, the higher the risk that you'll probably take. The newer you are to it, well, then the less risk you'll probably take. So I will say I understand the basics because I think that's probably where most people are. So let's click on that. And here is their little risk reward chart. So the big thing, ignore the graph and just pay attention to the numbers right here. So if I slide this to the left, which is a great place to start, and let's go from there. So it says if I have $425,000 that I invested in Wealthsimple, in 2 years, if I'm taking their least risky portfolio, well, things could tank out and I could lose some money. I could have $379,000. Or if things go well, I could have $486,000. Well, that's okay. So that's a little bit of risk in 2 years. And then in 10 years, you can see the numbers here. Let's move up. So medium risk. Well, if I have medium risk and I go into their medium risk portfolio, well, I could have $333,000 or $539,000 within a couple of years. But you can see that, boy, the upside, if things go well, is really good. $867,000, that's all right. And worst case scenario for that right now is that I would break even, that I would lose the value of inflation. Let's say I take the highest risk, which is where I am personally. If I invested $425,000 today, in 2 years, things could really tank out and I could get $285,000 or I could be up to $610,000. And you can see though that if I put 425 in 10 years, it could get up as high as 1.2 million. So I'm going to say that I am risk averse and I just want to take their least risky option because I'm claiming I'm a retiree for the purpose of this demonstration. So let's scroll over here. And again, this is just another way to ascertain your risk. How comfortable are you with losing money? Because, well, things like COVID-19 happen. Airplanes crash into buildings. Things happen. The stock market is far from a guarantee, and everybody that's investing in it should know that. If you choose the lowest risk portfolio, Wealthsimple will put about half of your money into bonds from governments and large companies. So it's very, very safe. That being said, things do drop, and it's a problem. I had an amount invested with Wealthsimple, and in COVID-19, it dropped about 10% in about 2 months. Now, compare that to what other investments have done, 10% is pretty good. And I can tell you that as of today, May 25th, 2020, I'm back up in the positives. And that's just from 18 months of investing with them. So that's pretty good. I'm pretty happy with it. And that's at their highest risk. My children have done even better with this. So let's continue and answer the questions. If you lost 20% of your 420K within the next 2 years, what would you do? Would you withdraw everything? Would you deposit more? What would you pull it all out? So I'm going to say in my case, because it's not that I'm risk averse, it's just that if things went down, I know that over time they'll catch up. So if it went down, I would probably put a little bit more in. So I would select that. Now let's go over. And again, this is just assessing your risk tolerance. And here you can see if I wanted to do the social responsibility thing, which I do not recommend for a variety of reasons. You could, although it's nothing to do with Wealthsimple, you could check on that and it would adjust the portfolio and eliminate cigarettes and booze and other things. but it will also probably eliminate some things that you are not offended by that other people are. So socially responsible is a loaded phrase. So let's take a look at what it's offering us. So in this case, it's offering us 35% equity and 60% fixed income. Wow, that's even more than I thought was possible. And I believe in the past, the most they had was 50-50. So this is 65% fixed income and 35% equity. That's really quite interesting. So let's click on View Holdings, and you'll see what you get. So what they would buy is they would buy 10% of global equities. And specifically, what they would buy is the stock ticker BTC, which is the iShares. iShares is a massive company that sells ETFs and creates ETFs. And this is their minimum volume global ETF. What else would be here? Emerging market ETF. So you get a little bit of exposure to places like China and Brazil and Russia. Not a lot though, just 10%. So international, they're going to use BlackRock, again, another giant ETF company. And they'll buy the iShare Core MSCE fund, which gives you exposure to Europe and Australia. US equities, 5% through Vanguard, again, another giant ETF company. And a small amount of Canadian funds through BlackRock. And that's fine. But here's where the real money is going. It's going into government bonds. It's going into Canadian aggregated bonds. Let's just take a look at those. So it's going to use Bank of Montreal Discounted Bond Index. It's going to use the government bonds, the BMO again, Bank of Montreal Federal Bond Index. And it's also going to use the McKinsey. Again, McKinsey, another giant company. It's going to use their bond function. So at this point, that's really all I need to do. I can scroll to the bottom here and I can select, look, I appreciate what this is, but I like talking to somebody. So I could either just click start with this portfolio, or I could click schedule a call. And a guy will give you a call. And when I say a guy, these guys aren't commissioned. They're not like me. I'm not making anything at it. It's the job. Although, by the way, this isn't my job. This is just something I'm doing because I have people asking me, as I've said before. So once again, I'm not gaining anything from this unless you use my link, in which case I have the fees reduced on $10,000 worth of my investments. But that's very minor, so take it or not. I appreciate it if you would do it, but it's hardly a big deal. So I'm going to open this up with schedule an appointment. And you can see here, all you do is click on a time and say, well, I would like to call, well, let's see, I'm in Calgary, so I'm going to use Mountain Time. And I want to call on May the 27th at 9:30 a.m. And I've done this a couple of times before for various reasons. And they'll call you right on time. They'll talk to you for 20, 25 minutes if you want. They'll schedule additional time with you. Or you can just go create the account and you can phone them anytime you want. Like I said, they're open, business hours. I think it's 9 a.m. to 6 p.m. virtually every day. So I'm just going to go back here and I'm going to click start with this portfolio. And what would happen is at this point is they are going to send an email that I have to receive and click a link on it to verify that that email is correct. After that, it's going to say, well, look, we need to wait a couple of days to verify that your social insurance number is valid and that your address is correct and that your birth date is correct and blah, blah, blah. And then what will happen is that they'll say, okay, how would you like to fund the account? So how do you get money in? There are 3 ways to fund your account. You can transfer it from a checking account. So in other words, all you do is inside Wealthsimple, you enter your bank information. So you'll say, well, I'm with CIBC, or I'm with Scotiabank, or I'm with, doesn't make a difference, whoever it is. And you enter your banking information, and then you can make a request to pull money from your Royal Bank or your CIBC or your whatever it is into Wealthsimple. And for that matter, by the way, you can also do the opposite. So when you want to pull money out, you can transfer the money out, and it takes, 3 or 4 days for that to happen. So it takes a couple of days for the money to come in and 3 or 4 days for the money to come out. So this is like a cashable GIC, if you're thinking in those sorts of terms. You can also have an automatic recurring deposit, which is just that. So say you're paid every 2 weeks, you could have take out a set amount as you wish. Or you could just transfer an existing investment altogether. So let's say you worked for some organization and you have decided that you're leaving the company and you want to keep that RRSP that they had set up for you. And you really just don't want to touch it. You don't want to play with it. You just want to move it. So, well, you can transfer the entire thing into Wealthsimple. That's really not the point of this conversation, but you can do that. And in the middle here, you can see that they have a phone number. If you have any questions, just give them a call. Yes, you could send them an email, but it's just so much easier to phone them. So just give them a call. They're friendly, they're fast, they're not commissioned. And kind of important thing, the people on the front lines are authorized to make whatever changes are necessary. So you won't get the, well, I got to go talk to the manager and we'll see what we can do. Stuff just doesn't happen with them. At least that's been my experience. I've been with them now for about 2 years. I've been very happy with them. My children are with them. My in-laws are with them. And I use it as part of my diversified portfolio. So I think that's about it. If you have any questions or concerns, please get a hold of us at www.partisanissues.com. Thank you. Bye-bye.